The Reserve Bank of India has raised repo rates by another 35 basis points today. It's in line with street expectations. But what does this rate hike mean for the end user like you and I? If you have home loans, car loans, or just about any other loan, obviously you see your EMIs increase again or your tenure increase. Remember, this is also a series of rate hikes that we've seen. In the last year, since May this year, the Reserve Bank of India has hiked interest rates by about 2.25%. Quite a bit of this has been passed on to the end consumer. So this is the harsh reality. My colleague Hersh is now joining us to find out how EMIs for 20-year home loans have been impacted for borrowers in less than 1 year.
Well, yes, the latest hike of 35 basis points by the RBI means that interest rates and the repo in India has gone up by 2.25% since the May of this year. So that is that they've taken the repo from 4% to 6.25%. Now, what does this mean for your EMI? So say you have a 50 lakh rupee EMI back in May with a 20-year tenure. Then typically you were paying an EMI of around 38,018 rupees per month, which has now systematically gone up all the way to 45,000 rupees, almost 45,000 rupees. So that's clearly seen an increase of nearly 18%. This 2.5% increase in the repo has led to an almost 18% increase in EMIs. Similarly, when it comes to the total cumulative interest that you will service over the period of over the lifetime of your loan of 20 years, that will mean that earlier you were going to be paying 41 lakh rupees of total interest across the tenure of the loan, and now you're paying nearly 40% more. 58 lakh rupees is what you will pay in terms of interest component of your home loan of 50 lakh rupees. Now, this is obviously 40% higher compared to what you were paying earlier, and this little tweak of the repo will have this impact. Of course, alternatively, banks also offer the option of increasing your tenure and keeping your EMI the same. But largely, both of these factors will impact your total interest payout over the larger tenure of your home loan.
So your overall payout is going up. It's going up consistently. It's unlikely in most cases that your income has shot up by the same degree. If it has, and that's great for you. But what is the impact that interest rates and hikes in interest rates have eventually on the end consumer, and are we coming towards the end of the cycle? Remember, one important statement from the RBI Governor Shaktikanta Das today was that the worst of inflation seems to be behind us. Does that mean we will soon see maybe a cooling off or an easing of this interest rate hike cycle as well? To speak on some of these aspects, I'm joined today by Indranil Pan, Chief Economist, Yes Bank, Anubhuti Sahai, Head of Economic Research, South Asia, Standard Chartered Bank, Gautam Kalia, Senior VP at Sher Khan by BNP Paribas, also speaking with us today. Welcome to all of you, and thank you so much for joining us on the India development debate. Mr. Indranil Pan, just your view first on the interest rate hike. And today we're also trying to take an approach from the point of view of the end consumer and how we have seen interest rates going up consistently. Are you seeing a dampening effect at all, and will we see a dampening effect at all in terms of demand?
You just spoke just before we were let in, you were speaking on how the EMIs have gone up. My sense here is that it has not really dampened the elite sort of demand so far as housing is concerned. Very unfortunately, we don't hear anything very significantly on the type of demand that is in the affordable space. I would love to hear something on the affordable space. So here what we are talking about is a very significant unequal distribution of income. And even as interest rates are going up, it is not really denting the demand of the housing sector. Plus, certain state governments have also moved in with lowering of the stamp duties, which is also sort of helping keep demand intact. Now, I don't know how many of us have sort of looked into the consumer confidence survey of the Reserve Bank of India. It incidentally says that the demand for the non-essentials for the first time in a few surveys have actually gone up. The future expectations of demand for non-essentials have gone up, which clearly means that the RBI's assessment of the fact that the Indian economy is relatively resilient is standing out in terms of these data points that we are talking of.
So the Indian economy is resilient. We're seeing some reflections of that in what the Reserve Bank is saying today. Ms. Sahai, in terms of the view that the worst of inflation is behind us, do you think that there's going to be a turn in the interest rate hike cycle as well?
Obviously, Tamanna, there will be a turn in interest rate cycle. We think that would happen, in three stages. First of all, we still expect another 25 basis points of rate increase in Feb 23. So there is still more, one more hike in the pipeline. After that, there would be a prolonged pause, and it will then be followed by a cut. Right now, our view is of a prolonged pause. We are not building in cuts just as of now. And the reason is that even though the worst of inflation is behind us, there is a fair bit of uncertainty as far as commodity prices are concerned. And there are a lot of external risks. So the inflation outlook, which Dr. Patra also highlighted today, seems to be of a downtrend, but the path might remain very uneven. This was something which Dr. Patra talked about, and we agree with this assessment. So yes, the worst is behind us. We know that we are on our way to lower inflation, but will it be a linear trend or will it be a zigzag trend is something on which the RBI and economists like us would remain pretty cautious.
Gautam Kalia, now let's come to the perspective from the borrower. What is the borrower to do at this point? Grin and bear it?
Unfortunately, the borrower has limited options, especially if you've already taken a loan and your lender is increasing the rates consistently. And you see that your EMIs have gone up by about 18%. One of the strategies that a borrower could use is try to prepay the loan, part prepay as much as possible. It's bonus and incentive season in the next 4-5 months. And once people start getting their bonuses, maybe they'll look to put part of that to prepay part of their loan. Some borrowers we're seeing, especially when we are managing investments, we see some of the borrowers who didn't anticipate such a big increase, and they didn't have much margin of error. Those people have actually increased their tenor of the loan and kept the EMI the same. In that situation, you actually end up paying much more. So while EMIs have gone up maybe 15% on an average, 10-15%, maybe in some cases 20%. But when you increase the tenor of the loan, you end up actually paying for significantly longer. Just for an example, someone who took a car loan for 5 years last year is probably with the same EMI going to pay a loan for the next 5 years. So it's not like with 1 year gone, the tenor has reduced. It's just that they've had to pay, now they'll have to pay another year. So really that's the impact that we are seeing. These are the options available for investors and borrowers.
The flip side, of course, of a rising interest rate regime always is higher savings rates. But is that impact or is that benefit really being seen, Gautam?
What has happened is traditionally there's a lot of investments and savings in physical assets, and what we are seeing is this increasing trend of financialization of assets that is happening over the last 3-4 years, and that's indicative in the SIP flows in the industry. That's where you see most of the retail money moving from 6,000-7,000 crores a month to 13,000 crores a month. So you definitely see that, but now with fixed deposit rates becoming more and more attractive, the yield gap between debt and equity, reducing, you'll see again more interest coming into the fixed income space from investors, including fixed deposits.
Indranil Pan, in terms of an outlook for the economy, and let's talk a bit about the GDP outlook, the narrative globally has been that India is relatively a bright spot. You had the World Bank actually increase their outlook for FY23 for India, and today the RBI has come to 6.8%. So that seems to be the broad consensus between 6.8 and 7%. Do you see that sustaining, or are we going to have to brace a bit for headwinds coming our way due to a possible global recession next year?
I think the RBI is pretty clear about the headwinds. In fact, if I pass through the professional surveyors, the median survey does indicate a 6% level for the next year. The RBI also possibly is likely to talk more in the range of 6.2 to 6.3%. So that is where the overall sort of assessment of the economy in the next financial year is headed. But as the RBI says, it's still a bright spot in the sense that we will still be one of the strongest growing economies of the world. And to that extent, we will probably be able to attract as much of capital as we need. And the RBI is also hopeful of the fact that in the budget, the government will continue with its expenditure strategy, try and skew it more towards the capital expenditures, given the fact that some of the committed expenditures of the current year in terms of food subsidies and fuel subsidies may actually be lower in the next year, with oil prices, for example, having come below the 80. So these are some of the factors that can be positive and that can form a significant sort of enabler for the economic growth. But having said that, yes, we are looking at some headwinds in terms of mainly the export market. The other thing that, as I pointed out, the consumer confidence survey is stronger for a 1 year hence period. And if we don't have much surprises from here on, that to a certain extent may also hold the economy up.
So the focus on domestic demand, a strong consumer demand continues. Mr. Hai, you know, your response to the kind of commentary coming from the RBI today vis-a-vis the economy, and of course the fact that the World Bank did increase their India growth forecast for FY23 just yesterday.
Yeah, so completely agree. But I think we need to look at it in two parts. First of all, the current assessment that the economy is relatively a bright spot. It's a comparison to the other economies, especially like US, etc., which are headed for a recession. So India, first is India versus rest of the world. The second part is to focus on how India would do in FY24 versus FY23. Our forecast is that this year India would grow at 7% and then slow down to 5.5% in the next financial year. We are below consensus as far as GDP projection is concerned. And I think while the current high frequency indicators do flag ongoing recovery thing, we need to remain cognizant of the moderation in demand, which is ahead of us. Pent-up demand will get exhausted as we move into the calendar year of 2023 or fiscal year of 24. Rate hikes, RBI, assuming they do another 25 basis points of rate increase in Feb, they would have hiked rates by 250 basis points, and interest rate would start pinching the consumers at some point in time. Not to miss out, even if we are talking about inflation moderating next year from, say, 6.6% this year to, say, an average of 5% in the fiscal year of 24, absolute prices are still high. And that would erode purchasing power of the consumers, especially if you're looking at the rural India. So I think we have to remain cognizant of the fact that, yes, India is a bright spot today when we compare it to the other countries. But it's equally true that next 12 to 18 months, we will see a moderation in economic activity setting in India on the back of host of domestic factors plus global slowdown. I think that point should not be missed out in this whole statement about India being a bright spot in an otherwise gloomy global economy.
All relative is the key point to remember. Thank you so much for joining us today on this discussion as we break down the narrative and the signals coming in from the Monetary Policy Committee, and of course a pinch for you, the consumer, at the end of the day because of ever increasing interest rates. Thanks once again.